On the business side, as you'd expect, not a huge amount of change. As a reminder, we remain wide open for retail investments. We've closed the books now for institutional capital. As you can see by that pie chart there, we continue to focus on that grey colour of the Australian wholesale trust as our retail part of the business and grow that out with some fantastic clients we've picked up in the last 5 years or so. Company meetings for the quarter, a little lighter than usual, being Thanksgiving and obviously Christmas and those kind of things in calendar Q4. We did speak to 20 of our existing investments and another 80 of what we'd consider to be channel checking potential investments or just keeping abreast of the stocks that we like in certain parts of the world. During the quarter, we retained our Zenith and Lonsec ratings as recommended, which was obviously important for a lot of your business practices, and it's important to us as well. Both of those reports did cite a consistent process and philosophy as well as good team stability as parts of the reason we retained our recommended rating there. In terms of platforms, we are available on all platforms now with the exception of, I believe, Colonial First Choice, so there's plenty of avenues to access the fund should you desire. Quickly, we'll go through some of the geographic attributions, just to talk through where the performance came through during the quarter. Do remember that the quarter was a strong one with stocks up globally about 6.2%. So for us, North America was the biggest contributor. We had some great relative performance there, particularly in our industrial stocks. Whether it was tax reform necessarily, which was obviously a very large deal for US corporates, also some signs of inflation and general business optimism has really put the icing on this rally in US markets at least. Emerging markets was another great area for us, has been a good area for us in the last 2 years or so. Ongoing confidence with stability in China, commodity prices being elevated, and some political reform in places like India and South Africa has given some more confidence around emerging markets, leading to some investor optimism. We had some great stock picking in that part of the world. Japan stocks are at their highest level since 1991, which is quite staggering. Kind of been an economy that hasn't really had a lot of growth in the last couple of decades. It's starting to grow a little bit. We still think the bulk of this rally is in multiple expansion. It's been very, very stimulated by QE and the government buying stocks and bonds and printing currency. On the sector side, consumer staples was our largest area, as you can see there. This really can be dumbed down to our emerging markets, consumer staples names. We do like playing EM through branded consumer goods, and we can talk through some of the stocks later, but it gives us good exposure to faster growing economies, and it also gives us some a little less cyclicality than investing in EM through perhaps exporters or cement companies or buildings products or these kind of things. We do prefer to play EM through consumer goods. Industrials, this really was our US exposure. We quite like our industrial exposure in that part of the world, and contrary to quite a lot of other managers, we think industrials in the US are actually better placed than many other parts of the world, such as Europe, which I know has been a favourite part of the world for some fund managers in the last month or so. Flicking over to slide 6, we can get into the stocks a little bit. So the top one, Tata Global Beverages, had a really strong 2017 calendar year, was up 180% for the 12 months. This was really, for us, it spent a lot of time being, I think, ignored by investors. It's been a great story for a long time, but there's been some political change in India with the election of Narendra Modi a couple of years ago. Has brought in some structural change. I think in terms of the USA and their relationship with emerging markets, India is probably the strongest ones. There's been some great trade relationships forged between Trump and Modi, and this was evident at the Davos conference last week. This business, Tata, owns the Tetley's tea brand globally. It has joint ventures with Starbucks and Pepsi. Great management team. It's certainly had a great run here for us. Just as people get their most optimistic, we tend to get a little pessimistic. So for us, we're happy to have taken the performance in the name. We still own it. It's still a big weight for us, but we're more likely to be on the sell side than the buy side of these levels. KLX, number 2 there, and another great stock for 2017. This is an aerospace distribution business which we've owned since it spun out of BE Aerospace a couple of years ago. KLX benefits from the ongoing growth in global travel, particularly aerospace-based travel. It's a distributor of parts which are needed to overhaul and perform routine repairs and maintenance on aircraft which are docked at airports at any given time. During the quarter, they announced a strategic alternatives they were exploring and ways to unlock some value in this business, which the market liked. There is a small oil and gas business within KLX we think could be sold, and the market's not giving a lot of value to that at the moment. The next 2, Cash Build and Pioneer Foods, are both South African listed, so emerging market stocks. South Africa's been a volatile part of the world with some political issues and regime changes there. It appears to be showing some signs of stability, which has led to some buying to these 2 names. We've owned them both for a long time. Pioneer Foods, for example, would be similar to a Kellogg's or a Sanitarium kind of business model, or perhaps the old Goodman Fielder here, where it makes bread and cereals and fruit juices. Mandom, cosmetics business in Japan, which exports into Indonesia as well. On the negative side, the top one there, Eros, is the largest Bollywood content owner. As I'm sure you've seen with the growth of Amazon Prime Video and Netflix and these kind of things, content has become a very, very scarce and very valuable asset. Eros ebbs and flows with moods around whether it be content in general, content inflation. This particular company's had a history for us, which we've owned for a long time. It's been a good performer for the most part. At this size for us, in terms of position sizing, we think it's weighted accordingly given the potential value of that asset, but it will certainly trade around with headlines until we think that's unlocked. Kodak has been another stock which in the past has had operational challenges, which when we are investing in these special situations, it's challenging to get the exact timing of when things are going to work out well. Subsequently, during January, Kodak had some positive news flow, and we actually exited a very large portion of that asset, which is nice to sort of mark the end of that chapter for us. And the other names there, Prologis is a REIT in Mexico. Most of that negative attribution is in currency. And the balance of those names there really are quite de minimis moves in a market that's been so strong. Looking at the next slide here on the positioning, I won't go through every single name. I think the ones to highlight is our preference for the United Kingdom over Europe at the moment. It shouldn't be a surprise to our long-term investors that we do tend to be contrarian in nature. Obviously, there's been some poor company announcements out of the UK, which is throwing some light on how the uncertainty around Brexit has translated into consumer behaviour. Our stocks have all done very well in Europe and the UK at the moment, and we do like the geography. We've benefited nicely from the pound. We've had a great carry trade in the pound, and our stocks continue to do well there. They are global businesses, so they're not just focused on how the UK goes. And we also like the tax rate at 21%. Conversely, in Europe, what we look for, the suite of assets in Europe just hasn't really stacked up for us. The stuff that's rallied in Europe has been a lot of the financials. We prefer our financial exposure in the US. There's been some lower quality parts of the European market rallying, such as the automotive sector, which we think is inherently a low multiple business. We can get similar exposure in the US at cheaper rates. We have added a couple of small names in Europe. One was a IT consultancy business in France. We added to an industrial cleaning asset listed in Denmark. And we do see some very minor green shoots in parts of that economy, but a lot of the rally we think so far has just been on pure optimism that things will get better in Europe. Outside of that, our emerging markets weight at 22% probably differentiates us from some of our peers. We have been bulls on the long-term thesis of EM since inception, but we've really only increased our weight in the last 2.5 years when EM got really cheap. So whilst we do like the long-term thesis of emerging markets, we do believe that you need to be very conscious on the value that you're ascribing to these assets. Working down the list there, Japan, we're underway. Again, I did touch on earlier that has been a rally surrounded by multiple expansion. We really like our 4 or 5 stocks there, but I wouldn't necessarily say that Japan's a great place to be fully invested right now. North America, really chiefly that's made up of our industrials and our financials and a little bit of consumer discretionary, nothing in Australia, and a little bit of cash there at 6.5%. Just on market cap, we're about 2.5 to 2.7 billion weighted average market cap at the moment. That's in USD. That number's been pretty consistent since we started this fund, despite having good asset growth. That has been a sweet spot of the market for us in terms of where we can find great management teams, opportunity for M&A, and also good trading liquidity to manage risk. Nothing new on the sector side, really. We still avoid a lot of what we consider to be low quality or poor ability to compound industries. So energy being one. Materials, again, this is a geek sector. For the sake of this, I mean, that bucket ends up with almost a 10% weight in materials for us. In reality, they should all be in industrials, and that weight should be 25%, not 14.6%. So for us, avoiding low compounding sectors like energy, materials, telcos, and utilities, and we can really get some nice exposure in our portfolio into these compounding asset class, which is really important to us. Look, from a top down, we're not macro investors, but just as the way we're thinking about the world here, we think there's obviously the headlines are saying that global growth is as strong as it's ever been. We probably haven't been this positive on global growth and generally on corporate environment for a long time. Unfortunately, it's coincided with stocks being priced at very, very elevated levels. So for us, when we're seeking out opportunities for new investments or even existing, the dislocation we look for, which often comes from the macro, at the moment it's more coming from individual companies that have gone astray for whatever reason. So right now, I think the basis of what we're doing is more than ever very much bottom-up fundamental stock picking. And that's the way we like to invest, rather than it's nice to take the macro out as much as we can and just focus on what we can really control, and that's investing in ideal companies, strong balance sheets with management teams that have got good allocation of capital. So for us, the portfolios hasn't changed a lot. It really is that's ongoing focus on capturing most of the upside of the cyclicality and the beta rally we're having. But if and when, and there will be a sell-off at some point, we're also preserving capital should that come about. Thanks for dialing in. If anyone's got any questions, please throw them in the dialogue box. I'd be happy to answer any. I suppose we should get to the important part first on the performance slide. Like I mentioned, we gave back a little bit of performance for the month. Quarter was a very strong one for stocks in general. We're more than happy to be 20 basis points under that benchmark after fees in such a strong month, bearing in mind the quality and the risk-adjusted nature we invest in. The one-year number looks strong, and for us, we set about internally to compound capital at 15% rates of return through a business cycle, and I think that since inception number really speaks to that focus on compounding. And benchmarks will do what they do, and as long as we're looking after the absolute return as much as possible, then that's our focus.
All right, we have got a couple of questions that come through. So, Paul, I might kick off with one of the first questions. On most valuation metrics, global equities appear expensive. When you overlay macro and political risk, it makes it even more tricky to invest. How are you positioning the portfolio in light of these headwinds?
Thanks for that question. Look, I think most asset classes now are exhibiting some signs of pro-risk behaviour. Equities bears the brunt of a lot of those headlines about what's expensive. But whether you look at bonds, or even some of the more esoteric assets like cryptocurrency mania at the moment, the ends of bull markets or bull markets that are deep into their life start to exhibit these signs of pro-risk behaviour. We definitely agree with your summary of the world being expensive. Look, for us, that's always going to make the value manager a little sceptical, and we're going to be on the contrarian side. It's certainly pleasing to see a lot of big M&A and things like semiconductor, and it's nice to see management teams which are confident doing large M&A in cyclical businesses. But for us, it makes us more and more nervous. So how do we structure the portfolio? It's owning some more things in consumer staples. It's holding a little more cash. It's owning these really well-capitalized financials, especially in the US, which are over-capitalized. It's gearing away from valuation methods which start to look out to 2021 or 2022 or years from now. I think the complacent analyst in this market starts to model things by 6-7 years out, growing top line at 10%, and you can make anything look cheap like that. So we continue to think about the economic reality of these franchises. We continue to seek out management teams which are not exhibiting this pro-risk behaviour, but actually taking some off the table here and being a little more conservative. So for us, as I touched on in the prepared remarks, I think it's focusing on those characteristics of companies which are going to protect you in the downside, which is good balance sheets, sustainable franchise business models, and good management teams at the right valuation.
We've got another question here that relates to rates in the US. What do you think is the likelihood of a interest rate rise in the US or rate rises in the US this year, and how are you positioned to deal with any such rises?
Yeah, I mean, interest rates will really only rally if there's a meaningful pickup in inflation. And whilst I think QE was designed to create inflation, we really haven't seen that pick up because QE has gone into hard assets like real estate or equity. So you haven't seen the velocity of money go into the market. That started to change in the last year or so, but particularly there's more anecdotes in the last 6 or 8 months about the inflation environment. And a few things are at play here. I think there's definitely an economy at full employment. You're starting to see a pickup in oil and gas, which is obviously highly inflationary for economies. There's been several single one-off bonuses paid out by American corporates such as Walmart and some of the large American businesses which employ a lot of people that are giving out $2,000-$3,000 one-off pay rises as a result of tax cuts. So our hunch is that this actually does lead to meaningful inflation faster than what the Fed's predicting. And our view internally is that rates pick up faster than what the Fed is communicating to the market, which would mean that bonds rally. And then, again, we're talking our own book being value investors, but we certainly hope in equities that as bonds sell off and interest rates rally, the difference between owning equities and bonds becomes more meaningful, and people are far more discerning about where they place capital. Now, our fund and the way we invest is much cheaper than the broader market, so we tend to think that as bonds rally and equities become more discerning in terms of where people want to invest, that we get the opportunity to see value start to outperform compared to growth.
We've got another question here, Paul, regarding the cash. So over the last 10 months, your cash position has dropped from around roughly 10% to closer to the 6% mark. And over that period, your EM exposure or emerging markets exposure has actually increased. Can you provide some comment around that, especially as valuations have risen in EM and how EM stacks up versus developed markets?
So we actually haven't added to our EM exposure by any names. It's simply been through our performance in those markets. The decline in the cash has been, I mentioned a couple of new names in Europe, which we initiated at around 1% each. So there's about 3% there. One of them was actually an existing stock we owned, which spun out, and we liked the spin-off. So we added to that as it spun out. So there's no there's no major change in our thesis of we need to go to 2% cash because we're really bullish. It's just been the timing around when things have popped up, and all of the stocks which we've added to it had their own reasons. We haven't just added to Europe because Europe went up. It was simply a matter of the spin-off I mentioned, or a certain stock which got cheap for its own reasons. So generally speaking, yeah, I would agree that valuations have increased in DM and EM, and the fact that our cash has drifted a little lower is simply that we had some opportunities to deploy cash. And whilst we do keep that cash there as a way to manage risk, it's also there to be invested at some point. And if we find sufficient ideas to deploy that capital, then we're more than happy to do that. It's funny how these things come and go in waves sometimes.
We might just got one last question. Have you had any recent buyouts in the fund?
Yeah, so we talk about in our marketing documents quite often about the way we invest is conducive to some of our funds being taken off our hands at nice premiums sometimes. There was nothing meaningful during Q4 or Q2, depending on what year you're looking at. However, early in this year, and we'll have a note out in the next couple of weeks here for our January commentary, we had one of our financial service providers in the US had a buyout from one of their competitors at a nice premium. So a stock we had for a couple of years, and it's compounded at mid-20s rates of return thanks to the buyout. So that will come through some commentary around that in the Jan commentary. But yeah, it's nice to see that theme continuing, and it's one we expect to continue as well.
We've just got one more question regarding IT, and we've seen IT being a large allocator within large caps towards IT, with opportunities opening up there. Are you finding a similar trend with small caps and IT?
Unfortunately, because of this changing structure of the market and the amount of private capital there is in the market these days, we're finding that the IT or the software or the SaaS providers that actually exist in the small cap end of the market are the ones which venture capital or private equity didn't want to fund, and they come to the equity market for funding, which is not typically a fantastic sign. So for what we do, we have we've got a medical records business in Germany, which does online medical documents for general practitioners and chemists and these kind of things. It's a nice business, but it's not like the IT I think you're alluding to being social disruption or social media or these kind of things. It's more traditional kind of IT. We own another technology platform which is similar to Link or Computershare. That's listed in the UK. We have a payment processing business called Global Payments, which we've owned since inception, which has compounded from under 2 billion market cap up to 15 billion. So we do have technology platforms which are fantastic asset-light business models, but we haven't seen the really big disruptive IT such as a Tencent or a WeChat or PayPal, some of the more headline-grabbing names, I suppose.
All right, I think we might leave it there. So thanks everyone for your attendance today and for your questions as well. And thanks, Paul, for that update. We look to conduct these webinars on a quarterly basis going forward, and you will be receiving notification from us about future webinars. If you do have any questions that come to mind post this webinar, please feel free to email either Dario Conti or myself, and we'll get back to you. Thanks once again for your attendance. Cheers.